Yeah, I'm losing my edge.
Today, I want to talk about buying markets lower using options. This is something that um, it's I guess, a simple seeming concept, but I don't think people totally grasp a lot of the times because when you're selling a put, you're in essence buying this market lower than it currently is. A lot of people who come from the world of Robin Hood stock picking and futures outright trading, for them, it's really just, I need to buy this thing right here, and I've got theoretically a 50-50 shot of it moving higher. Options a lot of times will push those probabilities a little bit closer in your favor if you are using the sale of those options to better your break evens. They can do the opposite. If you're buying out of the money options, they take your probability from 50-50 to usually lower. And it's not to say that a better probability, a better break even necessitates success, right? Like the payoff structures of those options are so efficient that if you bought an out of the money call and now you went from a 50-50 chance if you had just bought that market to maybe a 30% chance or a 20% chance because you bought an out of the money call, the cost of doing business there, the cost of that option is going to be theoretically less than the cost if you were wrong on that 50-50 trade and the outright went lower by a good amount. So all those things are efficient, but you do have these opportunities to use options to, in theory, just buy markets lower. And you'd think with the small US dollar here back at its lows on the year, the lowest prices that you've seen in the US dollar going all the way back to June 2018, which is like a million years ago, you wouldn't need options. And this, I think, is definitely an interesting trade to jump on the bullish side of, the long side of. SFX here at those new lows. We've only seen this market below 148 about 15% of the time going back to 2016. And like I said, this is the lowest price since summer 2018. So definitely a price extreme there. But I want to speak a little bit to the idea of, okay, market's at just below 148, and I want to get long this US dollar against euro, Canadian dollar, Australian dollar, sterling, yen, Chinese renminbi, all these other pieces. But I want to get a little bit more breathing room. I want to get long way below 148. Maybe I want to get long at 147 or 146. And I don't have options. The easiest thing would be to go to SFX options and sell the 147 or 146 put for hopefully, a 60, 70, a dollar credit, whatever it might be. We don't have options yet on these small exchange products. I had a meeting earlier today to further push that process along, and all of the operations people here at the small exchange and the tech people are working on that constantly. They've got some great ideas, but it turns out creating options out of thin air is a lot harder than you might think. So we're going to get that going for you as soon as we can here at the small exchange. Until then, we got some intriguing fixes for you, and we're going to use these markets that are highly negatively correlated to SFX. Like I just mentioned there, the dollar trade, buying US dollar using SFX gets you long that US dollar against the euro, against the pound, against the yen, Australian and Canadian dollar here. And you can use these markets that the US dollar is basketed against that have these high negative correlations to help get your break evens in SFX even lower. And you see here, the highest correlation is the euro. Next is sterling, and then on down the line. But all, I think, great candidates. And actually, I think the worst correlation here of negative 0.55 in Canadian dollar, which is still it's teetering on the edge, but good enough for me. I think that actually might be the most intriguing piece, because you look at that Canadian dollar, it's the weakest piece, especially after today, sterling up another 1.5%. Big update in the British pound. I think that this Canada, both being the weakest piece and the weakest correlation, actually stands to be my best option to help lower my break even for my long USD trade, because Canada has been acting a little bit like this US dollar, hence the weakness relative to euro, up over 5% this year, yen up a few percentage points. and Australian dollar also north of unchanged on the year. I like going to this weakest Canadian dollar piece to help uh, lower my break even and use those options in that market. Now, how are we going to do that? Well, we're going to go to a put strike that is not, you don't want 50 deltas here. You don't want an in the money put that's even greater than 50 deltas, because the SFX contract is actually equivalent to about a tenth the size of these big currency contracts, which equates to pretty easily, if you were doing a one for one pairs trade, about one of the micro versions of these contracts. That being said, I like going to the 10 delta put strike for any of these markets. If you want to use any of them, I like /6C right now. That's the one that young Frank is interested in. All you out there can have your own biases. We've used the yen many times before, but now you see that yen has actually ascended to some pretty decent levels here. I don't think it's not my favorite pick for hedging some of my exposure in long U.S. dollar, and also helping me to bring my break even further down when buying the U.S. dollar. I'm going to that short put in Canada here. 0.735 is where I'm looking. That's right around the 10 delta. And hopefully you're here with me. Hopefully you're understanding all the gears are shifting, because if they are, this is going to look a lot like a traditional covered call trade, right? I'm buying SFX. And then instead of selling a call in SFX, we don't have options there. We're selling a call in a highly positively correlated market, like UUP, which is the US dollar ETF, but it's for a lot of different reasons. I would never look at it because it's small price, small implied volatility, makes for a real tough options trade in there. Instead of that, the call piece of it within the market or a highly positively correlated market, you can look to short put in a highly negatively correlated market, which these all have to offer. So I am creating that covered call position. And, you know, one of the great benefits of the covered call, I think the best benefit of it, is giving you that breathing room, pushing your break even down below where it would be if I just went there and bought the market. And yes, this is a trade that cuts off the upside in your long SFX position, because best case scenario here, your SFX, you buy one or two, a couple of these contracts, whatever you feel comfortable with. The market there bounces a dollar or two, and the Canadian dollar market, probably because of the inverse correlation there, negative correlation, the Canadian dollar is probably going to move lower, and you might lose a little bit on that short put trade. And so this is one that adding the short put and thus reducing that break even further below 148 here, actually currently, given current levels, you're actually pushing that break even below 147 using the short put in Canada, given where SFX is right now. You are giving up some of that upside. When you buy SFX alone, you don't put any covered call semblance against it or any options to help out that trade's break even. You do get the theoretical infinite upside. Now, everybody knows that theoretical infinite upside isn't very real, and anyone who's traded US dollar recently, we've only seen bounces of a couple of points, really not much to speak of. So for all of those reasons, I like adding the short put strike here with these highly negative correlated markets. I like 6C the best, but any of these you can use. I mean, if you're reading all the Brexit news, and that's the big mover here on the afternoon of October 21st, you can take all of that Brexit exposure out in one fell swoop by just selling the put in the 6B. Now, I bought my dollar. I've got some long 6B, some long British pound exposure that has, in essence, taken out my short British pound exposure when I bought SFX. So now I'm not really liable to those Brexit rallies like we're seeing here today, because I've taken that exposure out using the options there. But like I said, I like this Canadian dollar as the weakest piece. It's something that I think will be interesting and will be helpful in reducing that break even, and thus getting you long markets lower than they are currently with options.